In the meantime, let's also throw focus in Vaibhav Global, the raw material import and product export, the supply chain disruptions. Want to gauge all of that, and of course, the digital adoption, which has been accelerated at their end. Let me welcome on board Vineet Ganeriwala, the Group CFO at Vaibhav Global, joining in on the show right now. Vineet, hi, good morning. Good to have you on the show. Your customers have grown about 50,000, 500,000, I beg your pardon, plus in about FY21. Is a lot of the growth, you think, pandemic driven? Is the growth really sustainable? And what are the key differentiators, according to you, as you try and attain and only grow your customer base forward?
Good morning to you and your viewers, and thanks for having me here. Yes, we grew our customer base, unique customer base last year. It grew by about 39% year on year, and we reached the 500,000 mark in our customer base. Some part of that would definitely be induced by pandemic. So a lot of people were at home. So high TV viewership and heightened web traffic we saw throughout the last year. So some part would definitely be helped by this tailwind of pandemic. But our value positioning model, our business model is such, it works good in all kind of economic cycles. And we have been consciously working on that, expanding our product portfolios and getting good traction over our retention of old customers as well as getting new customers on board. So we are pretty optimistic of our future prospects, and we are pretty confident that this would continue in future as well. When the economies open up, a slight softening might be seen in some periods, but yes, we are pretty confident of delivering our guidance to the market, which is 16 to 18% constant currency growth in this year.
Sure. Just a little bit, deeper into the point that you mentioned on TV growth, which is definitely sped up. Unlike the expectations that people are going to watch lesser TV, tell us a little bit more about that. How do you see the trend going forward? And more importantly, do you see social media, OTT, etc., eclipsing the likes of TV viewing?
So we are an omni-channel player. We sell via TV, we sell via web. We are present in marketplaces like Amazon, eBay, etc. We use all kind of social platforms, Facebook, Instagrams, and the like. So this unique positioning gives a fantastic shopping experience to our customers and a high recall value. Besides, of course, the value positioning which we command. So in particularly talking about the TV viewership, while some sort of cord cutting or pay TV might see decline in the next few years, but our customer demographics, which is above 45, 50 years of age, the kind of TV decline is very, very low. And while this pay TV decline is seen in US, at the same time, the OTA homes are growing. So from 13 million homes, maybe 6-7 years back, now the OTA, which is free to air, homes in US is already crossed 20 millions. And we are also constantly increasing our presence out there. In the new age, streaming, OTT, etc. So we are consciously investing in that front and are increasing our presence there as well. We recently revamped our Roku app. We tied up with YouTube. So we are present in almost all digital OTT streaming devices presently available. Most of the prominent ones we are there. But having said that, so we definitely believe that TV has huge good potential for us across many years, and we would continue to grow in that space. We are constantly investing in low channel positionings, which would further fuel up the growth in TV as well. All this put together, we are pretty confident, like I mentioned. So if for this year, while we gave a guidance of 16 to 18% constant currency growth, we give a guidance of 15 to 17% for the medium and long term as well.
And where will this growth in terms of a geography largely come in from?
So while we will keep working on increasing our market share in US and UK, so right now, though we are growing at a CAGR of B2C revenues growing at a CAGR of 16% for the last many years, last 6 years, but still we are we have a market share of maybe at about 2.5 to 3%. So a huge runway in front of us, even in these two geographies. And we are pretty confident we'll keep on increasing the market share there. So part of the growth will come from these two geographies itself. At the same time, we are also increasing our geographical presence. So we announced our Germany company in January this year. So now our team is physically there in Germany already, with the borders opened up now. Our website is already launched in Germany. TV would be live to it. So it's already live on a partner studio, our own studio, which is under construction, will be live in another few days' time. So we announced that we'll be live in Germany in H1 this year, and we are absolutely in line with that. So we are pretty excited with this Germany venture. So Germany is a big market. The teleshopping industry there is more than $2 billion industry. The customer demographics, etc., is very similar to that what we see in our US and UK geographies. So we are confident that we'll be able to replicate the success of US and UK business model out in Germany as well. So part growth will come from US and UK, part growth will come from the newer geographies like Germany. And once we stabilize and operationalize Germany, maybe we would further look into other geographies as well, like Japan, etc., which are pretty conducive to this home shopping kind of a shopping model.
I just want to understand the overall cash on your balance sheet. I understand that you have about 450 crores at present. Your borrowing has gone up quite substantially in FY21. Is there any rationale for this, and where do you intend to deploy the idle cash on your books?
Yes, the cash is about 468 crores as of 31st March of last year. So we are retaining this cash for our future growth and acquisition opportunities. Borrowings which have gone up, part of the borrowing is of course for the working capital requirement for the Indian entity, and a part is only an accounting borrowing. So we subscribe to the Paycheck Protection Program in US, under which we were able to get about $4.8 million. So till that is approved by the US government, it is shown as a borrowing in the books of accounts. So that's why you see increased borrowing. Otherwise, the other borrowings have not increased at all in the last year. And the cash we'll keep on the balance sheet. We want to build a kitty for future organic as well as inorganic opportunities. Organic like Germany. So we plan to invest about $2 million of capex in rolling out Germany business this year, and similar other organic opportunities for future planned as well. Otherwise, any inorganic opportunities which comes our way. So we want to build a kitty of say about $100 million. And want to retain that cash. In terms of deployment, this cash is only invested in very safe bonds or deposits. We don't invest in equity. So to protect the safety of the capital, we only invest in safe bonds and deposits.
And what about your inventory levels? Are they substantially large as of now, and what's the reason for this?
So our inventory in terms of holding number of days have been going down in the last 2-3 years. So last March, we had about $60 million of inventory, which was in terms of number of days of sales gone down by about 20% year on year. So while absolute number might have increased slightly, but the sales growth have been much faster. So we are able to generate higher turns from the same inventories. We expect that trend to continue. In the particular period, so as you all are aware, there is a huge transit delays, etc., container shortage, shipping delays, etc., from China, India to US and UK kind of countries. So part of the transit inventory have actually shot up. We do not see any operational disturbance. We being a regional supply chain player, any transit delay, we are able to procure stuff from other countries and even procure locally from US and UK. To that extent, our operations are very smooth and we do not see any challenge in that front. But yes, because of this delay, some transit inventory would shoot up in the present quarter. But that would be a timing difference. As soon as the situation of all this shipment improves, we'll again bring that down like we did last year.
Thank you for sharing with us an outlook on your business, the company's financials, as well as your overall outlook on digital adoption. That's the word coming in from Vaibhav Global.